Investment vehicles are financial instruments through which individuals and institutions allocate capital to achieve specific financial objectives such as income generation, capital appreciation, liquidity management, tax efficiency, and risk diversification. Financial planners evaluate investment vehicles based on factors including expected return, risk characteristics, liquidity, time horizon, taxation, and suitability for client goals. Common investment vehicles include cash equivalents, bonds, stocks, mutual funds, exchange-traded funds, annuities, real estate investments, and alternative assets. Each vehicle possesses unique characteristics that influence portfolio performance and investor outcomes. Understanding these distinctions enables planners to develop diversified investment strategies that align with a client's financial objectives, risk tolerance, and overall financial planning framework. Cash and cash-equivalent investments are among the most conservative investment vehicles available. These include savings accounts, money market accounts, certificates of deposit, treasury bills, and other short-term instruments. Their primary characteristics are principal preservation, high liquidity, and relatively low risk. However, they generally offer lower expected returns than longer-term investments. Cash vehicles are commonly used for emergency funds, short-term savings goals, and liquidity reserves. Interest earned is generally taxable as ordinary income in the year received. Financial planners recommend maintaining adequate liquid reserves while recognizing that excessive allocations to cash may reduce long-term wealth accumulation due to inflation and opportunity costs associated with lower investment returns. Fixed income investments, primarily bonds and other debt securities, provide investors with periodic interest payments and the return of principal at maturity. Bonds may be issued by governments, municipalities, corporations, or other entities seeking capital. Key characteristics include predictable income streams, varying credit quality, interest rate sensitivity, and defined maturity dates. Fixed income securities are often used to generate income, preserve capital, and reduce overall portfolio volatility. Tax treatment varies depending on the issuer. Corporate bond interest is generally taxable as ordinary income, while certain municipal bond interest may be exempt from federal income taxation. Financial planners evaluate duration, credit risk, and tax implications when incorporating fixed income investments into portfolios. Equity investments represent ownership interests in corporations and provide opportunities for long-term capital appreciation and dividend income. Common stocks typically offer voting rights and participation in company growth, while preferred stocks generally provide fixed dividend payments with priority over common shareholders. Equities historically have generated higher returns than many other asset classes but also involve greater volatility and market risk. Dividends may receive favorable tax treatment when classified as qualified dividends, while capital gains taxation depends on holding periods and applicable tax regulations. Financial planners utilize equities to support long-term growth objectives, recognizing that diversification and appropriate asset allocation are essential for managing investment risk. Pooled investment vehicles such as mutual funds and exchange-traded funds, ETFs, allow investors to achieve diversification through professionally managed portfolios. Mutual funds pool capital from numerous investors and invest according to specified objectives, while ETFs trade on exchanges like individual stocks. These vehicles provide access to diversified portfolios of stocks, bonds, or other assets with relatively modest investment amounts. Taxation depends on the underlying investments and may include dividends, interest income, and capital gain distributions. Financial planners frequently use pooled investments because they offer diversification, professional management, operational efficiency, and flexibility. Their suitability depends on investment objectives, costs, liquidity needs, and tax considerations. Other investment vehicles include annuities, real estate investments, and alternative assets. Annuities provide tax-deferred growth and may offer guaranteed income features, making them useful for retirement planning. Real estate investments can generate rental income, provide diversification benefits, and potentially appreciate in value over time. Alternative investments such as private equity, hedge funds, commodities, and collectibles may offer unique return characteristics but often involve higher risk, lower liquidity, and greater complexity. Tax treatment varies significantly across these vehicles, requiring careful analysis. Financial planners evaluate the characteristics, uses, and taxation of all available investment vehicles to construct diversified portfolios that balance risk and return while supporting clients' long-term financial goals and objectives.